Well, welcome to Shadow of Truth, and today is Wednesday, April the 20th, 2016, and your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall with thedailycoin.org. How you doing today, Dave?
I'm doing well, thanks. How about yourself?
I'm all right, I think. Been dealing with computer problems, and that ties right into all of the economic problems that we're going to discuss. So we'll just jump in. What do you say?
That sounds good to me.
Did you see the article about China and Russia talking about a unified gold market between Shanghai and Moscow?
I did not. Where was it?
RT originally reported it, and a couple of people picked it up. And here's the thing. I'm going to read. This is directly from the article. The Bank of Russia and the People's Bank of China want to create a joint platform that would unite gold trading by the world's two biggest gold buying countries. BRICS countries are large economies with large reserves of gold and an impressive volume of production and consumption of this precious metal. In China, the gold trade is conducted in Shanghai. In Russia, it is in Moscow. Our idea is to create a link between the two cities in order to increase trade between the two markets. That is according to the first deputy governor of the Russian Central Bank, Sergei Shvestov. That is through TASS.
Yeah, I pulled it up. That's interesting. There's only one mistake in there. I mean, India is a bigger gold buyer than Russia, but
not at the central bank level.
Oh, at the central bank, yeah, that's different for sure. Yeah, India's central bank is trying to steal the public's gold over there.
It's not working.
They're not buying it. They're just trying to steal it, and it's not working.
Yeah, yeah. They've got one criminal temple in on the scheme, and they've in India, and they've agreed to deposit 21 tons, and they've only deposited so far like a little over 3 tons, 3.5 tons, something like that. That's all they've gotten so far.
Yeah, the only way the Indian government's going to squeeze gold out of the public, or probably even the churches or temples, is if they do it by force.
Exactly. I don't see that happening. So what do you make
I don't know. So far, George Orwell, pretty much everything he was writing about in the 40s is unfolding. You know, it didn't. You could maybe even say it started in 1984, and now it's where it was when he was in those books full swing, 1984 and Animal Farm. And his quote is, if you want to envision the future, imagine a face with a boot stepping down on it. And that, the idea there obviously is that eventually these governments are going to become completely totalitarian, and that's where we're headed. That's where we are in this country.
Pretty close.
So there's no reason why India's government won't become that way either.
Well, kind of hard to stave off 1 billion people.
But history shows us mass populations don't rise up. And, the question is, so for instance, the French Revolution, it was about 1% of the population was involved. The question is, are the technologies that are available to governments now, are they advanced enough to prevent a populist uprising? And I think they are. I mean, the governments don't even have to use a military to put down the public. They just use drones.
That's an interesting view. I don't know that I share that as far as the government being able to take us all out. I don't see that happening.
I didn't say take you all out, but I'm just saying anyone who's going to be involved in a revolution, they're not going to be able to. The government's going to be able to prevent that. The only way that I can see it happening is if it happens internally via the military.
Well, what do you think about what's your take on on Deutsche Bank now that you've had a couple of days to kind of let it stew and figure it out and develop some ideas? What are your thoughts there, Dave, on Deutsche Bank, or what are you seeing, I should say?
Well, and until I see differently, my view hasn't changed. I think they used Deutsche Bank as a stalking horse to. I mean, everyone knows there's manipulation, and the London market, especially when you look at it in light of this news with Russia and China, the London market's becoming almost irrelevant. I mean, a lot of the bullion that gets produced and delivered into countries like India and China and Russia, I mean, it essentially is going directly from the mines that produce it to refineries in Switzerland. It just bypasses London. So, big deal if they expose some manipulation on the LBMA. We all knew it was manipulated anyway. And,
yeah, but now it's at a much higher level. That knowledge. I mean, the gold.
It's not at a higher level. I mean, Deutsche Bank essentially had already been approached about. This agreement was already in the works several months ago, because I did some research on it and I came up with some articles from a few months ago that were talking about this. And Deutsche Bank wants to do whatever it can to survive, so it's going to give up some names. Maybe it gives up some emails. I don't know. We haven't even seen that yet. And point some fingers. And half of the banks who they're pointing fingers at are already not involved in the LBMA fix anymore. So who cares? The nexus of the operation, the heartbeat of it, is the COMEX. And other than HSBC, well, I guess Scotia was named also, but JP Morgan is the prime player there, and their name hasn't come up at all. And any time that anyone's tried to go after the COMEX banks in this country, they've been shot down by the courts. So until that happens, nothing's changed. As far as I'm concerned.
What role do you think the new fix in Shanghai is going to play? I mean, it seems like it's already having an effect. I mean,
well, it's hard to say. It's impossible to attribute the move that the metals have made since Monday. It's hard to attribute to any specific factor. I mean, first of all, so for instance, when the Deutsche Bank deal was announced, it was last Wednesday, and the metals snoozed. They yawned. That nothing happened.
Right.
And everyone has known. I mean, that the Shanghai event was telegraphed for months. So you would have thought that, it's sort of buy the anticipation, sell the fact. Buy the rumor, sell the news. I mean, you would have thought that the market would have already priced in the fact that the Shanghai yuan gold fix was going to happen. So it's not clear to me. You can't just necessarily say, oh, well, what's going on is because of Deutsche Bank, or what's going on is because of the yuan gold fix. I mean, for me, what I think is going on is I think it's the market reacting to the incredible and blatant central bank intervention that's going on, that's being used to keep the U.S. stock market from literally falling off a cliff. And that entails either money printing or expansion of credit. And that's what the metals, in my opinion, are reacting to. We've had, over the last 15 years, some of the best rate of return periods for the metals have been when the metals and the stock market all went up in correlation, and then at a point the stock market starts to negatively diverge and the metals keep going. And again, it's probably a little too early in the cycle to see if that's what's happening right now, but I think that's what may be happening.
I'll be glad when the central banks get exposed and this phony market, this phony stock market thing takes a turn. I know that the housing market is now changing, and you're in the heart of one of the cities that was affected before, and I know you and I have discussed this in the past, and that is a pretty good indication of of how the overall economy is doing as far as the housing market. Are you still seeing those signs there in Denver as far as the housing market going belly up? Is it stagnating? Is it just slowly declining? What's going on with it there?
Well, it kind of depends. I mean, you got to look at the various segments of the housing market. In one sense, probably the mid level is still, there's a fair, there's decent sales activity going on, and that's because of the easy mortgage credit that's being made available to buyers. I mean, I can't even believe how easy the credit terms are on the mortgages I'm hearing advertised on the radio. So again, it's sort of the wash, rinse, repeat cycle that we went through in the big housing bubble. And from a price standpoint, this bubble is even bigger than the last one.
Yes.
And it's just being driven by less volume. On the other hand, I'm also seeing, the NAR keeps promoting this idea that there's low inventory, and that's total nonsense. If you look in the Denver market, and I know this is true around the country because I get emails from all over the country, in the over 750,000 price segment of the market's being flooded. Absolutely flooded. I mean, if you drive all around the Metro Denver area through the higher end neighborhoods, it's shocking how many for sale signs are up. Some of these neighborhoods are starting to look like they did back in 2007 and 2008, where you got 2 and 3 homes per block on the market.
Really?
Yes.
And isn't that like the front end of the bubble bursting? I mean, when the big money, the smart money starts moving out of a particular segment of the market? Because I read earlier today, maybe over a Zero Hedge, that was happening in New York, that all the high-end property had fallen off it was in London, that the sales were down like 33 or 35% year over year on the high-end housing market, and that smart money was getting out. And is that do you attribute the same thing there?
It's the only thing I can attribute it to, because I've been watching this develop since last summer, where the high end neighborhoods, all of a sudden there was an avalanche of for sale signs, and you can drive through these high end neighborhoods and there's new price signs sitting on top of the for sale signs. I mean, I have a cell phone. I took a picture of one, and that house is still on the market. And I took that picture about 9 months ago.
Wow.
Interestingly, I did see that article about the London market. It was on Zero Hedge. And interestingly, since I've been following the housing market, which goes back to the mid-90s when I traded the sector as a junk bond trader, the London market tends to the trends that happen in this country happen first over in London. So if we're seeing London high end, the high end segment of the market, if they're selling their homes to try and get out, quote unquote, ahead of the curve and renting, which is what the article suggested, that's what we're seeing here also. And it means it's been going on in London probably for longer than that article finally picked up on. And again, I think at sort of the lower and mid-level price segments, it's all being driven by these 0 to 3% down payment mortgages. You can get these mortgages down to like a 500 FICO score. I mean, It's absurd. It is just absurd. And at some point, we're going to start seeing credit issues develop in the housing market like they're already developing in the auto market.
Well, the only reason that I brought it up is because of how that ties to the stock market that you were talking about on this endless ride upwards. And if the housing market is going down, leveling off or going down in most markets, I mean, I know in Denver it is, I know in San Francisco it is, because Wolf Richter over at Wolf Street, he reports on that market all the time. And it's a disaster, just like Denver is.
Well, Denver, I wouldn't say is a disaster yet, because there's still a lot of people moving here. A lot of them are moving here for the weed economy, and that's helping. But Denver's definitely slowing down, and at the high end, you're probably approaching a disaster.
Okay. Well, I know that like you had said, smaller amount of inventory driving prices higher. And that is certainly the case in San Francisco, where you have the median sales price for a home is already much higher than when they topped out in 2007, 2008. So they're already at somewhere around 10%, 12% higher in that market. What is the correlation between the housing market and the stock market crashing, as far as what we know from the recent history, Dave? Because I wasn't paying attention. I have to say, 2006, 2007, I was not paying attention to it the way I am now. So I don't know what that history is, as far as how the two were tied together. And are they tied together, or does it even matter?
That's a chicken and egg issue, but I'll circle back to that. I wanted to get, just revisit something that you had mentioned just a few minutes ago, which is that low inventory was driving prices higher. Now, that's the narrative that the National Association of Realtors wants us to buy into, and it's an absolute 100% fallacy. I did just a simple statistical study. You can do it using the Fed's website and all the data on the Fed's website. And I went back to, I think the data is available back to 98 or 99. And what I actually discovered, and I was surprised by this myself actually, but that periods of low inventory are actually associated with periods of higher sales volume, rising sales volume. And periods of rising inventory are associated with periods of declining sales volume. So in other words, it's the exact opposite of what the NAR wants us to believe. The level of inventory is inversely correlated with the level of sales volume. And I've written about that a couple times on my blog, and I've posted charts on there. If you do a search on my blog, you'll find the charts. Shocking, and like I said, it's 100% exact opposite of what the NAR says it is. And I've challenged Larry Yoon on this several times, and he refuses to answer, which shouldn't be surprising.
And who is that?
Oh, Larry Yoon is the quote-unquote chief economist of the National Association of Realtors. What his qualifications are to be called an economist, I have no idea. He's the chief propagandist of the National Association of Realtors. He's the National Association of Realtors' Joseph Goebbels, if you will.
There you have it.
So, but to get back to the idea of associating low inventory with price, and really what the correlation is price is correlated with the amount of debt that the buyer is allowed to take out to buy the house. So in other words, say up until probably the mid 80s, I guess. And again, I don't hold me on that exact era, but I know at least in the 70s, you put 50% down on a house, or at least 40%, or you didn't buy a house. You couldn't get the loan. And that transition, it actually transitioned during the Drexel era, when credit became a lot more promiscuous. And so then you fast forward and we transition, it used to be like when I bought my first condo in New York City, I think I put 20% down. And I don't even know if I would have been able to get a mortgage if I had only put 10% down. And I was working at a cushy Wall Street job. So it wasn't like I was a risky credit. And then you get into the housing bubble era, which Greenspan facilitated, and all of a sudden you got all those crazy no down payment, non-document loans, that mortgages that were being floated around, and that's what precipitated the housing bubble, the housing market crash, and then to sort of answer the stock market, housing market question, it was the collapse in the credit markets that then triggered the collapse in the stock market. But and so now we're in an era, supposedly they cleaned all that up, but guess what?
No.
At the same time they were talking about cleaning it up, all of a sudden the FHA rolls out a 3.5% down payment program. So they never really cleaned it up. They just introduced the FHA at a time when no one was watching what they were doing. It's that thing, that watch the ball. If you want to watch what a magician's doing, don't watch his hands. Watch what he's trying to do to distract you. And so the FHA has been issuing 3.5% down mortgages since 2008. And they were 2% of the market back then, and now they're 20% of the market. And then about a year and a half ago, Fannie and Freddie started doing 3% down payment mortgages. The USDA offers 0% down payment. The VA offers 0% down payment mortgages. So, in other words, what they've enabled is they've enabled people to take out a bigger loan with less of a down payment to buy a house, and that's what's chasing prices higher. Because it's not based on income at all. I mean, the price of a home as a ratio of the average median income in this country has never even been as close to as high as it is now.
Yeah, it's off the chart.
Right, and in San Francisco, it's the same thing. You've got all these mid-level employees at these tech companies that were funded by venture capital and private equity, and they were funded at $1 billion, $2 billion market cap levels, and all these employees have stock options. So they take those stock options that are real, they're paper millionaires, and they take that to a bank, and the bank lends them money to buy a house. And that's the dynamic that's driven up housing prices in the San Francisco Silicon Valley area. It's not a function of supply, it's a function of the availability of credit.
So it's in the true purest sense of the word, it's just inflation.
That's exactly right. It's inflation. It's credit-induced inflation.
More money, chasing fewer goods.
There's just one more point to throw in there about the housing inventory. The new home builders are sitting on a record level of inventory. Their inventories are as high as they were at the peak of the housing bubble, and their sales volume level is 50% or less, depending on the builder. So they're sitting on effectively twice as much inventory now as they were back then. And I'm reading and hearing all kinds of accounts from readers about home builders who are now trying to rent out their homes. There was a woman in Idaho who emailed me and said that there's a new home builder in her area. And granted, Idaho is not, the biggest population area to use as a test sample, but she said new home builders there are offering homes for rent on Craigslist. And so I'm sure that's not the only place in the country where that's going on. And that speaks to, the inventory issue as much as anything, and also the fallacies about the inventory issue.
Well, I'm just trying to get at the unfolding collapse, because we know that it's unfolding. We know that the rubber bands and chewing gum, Band-Aids are the only thing that are keeping this whole Ponzi scheme together. And I'm just trying to figure out, what step leads to the next step, to where we can actually see this freight train coming off the rails. I mean, I presume that some of the wheels are already off the rails. But from where I'm at, everything looks good. And I'm not just saying that. I mean, the Nashville economy is some kind of an anomaly because they can't build houses fast enough. They literally have 0 days on market here. But
there's a population dynamic going on there where there's a lot of people moving to Nashville because it's a great retirement area.
Okay. It's a
So
great retirement area.
those
But
people are leaving behind homes for sale in other markets.
that's what I've been trying to figure out is who these people are, where they're working, and how much money they're making at these jobs. Because there are apartments that are going up here at breakneck speed that are averaging $2,000, $2,500, $3,000 a month. And you got to be making, $40,000, $45,000 a year to even consider paying rent of $2,500 a month. I mean, unless that's all you have. I've got an apartment and that's it. It's gotten to the point to where I look around and go, this is getting ready to go. This bubble is on its last gasp, and it's got to go. But everybody goes, no, it's great. Everything's fine. Everything's beautiful. Look at how marvelous everything is. And it's like, I've seen this movie before. Didn't we just play this movie just a few years ago?
That's right. And granted, Nashville sounds like it's a complete anomaly, and I'm sure there's a few other markets around. I think Atlanta is the same deal. But you look at Denver, and Denver's supposedly a very strong market. And guess what? There's a glut of new apartment buildings here. You can go and you can get 1 to 2 months free. You can get free underground parking thrown into the deal. I mean, there's a serious oversupply of apartments that's developed in Denver. And if you Google Miami apartment condo glut, you'll find the same thing. There's several markets around the country where that's the case. So it's like, it's not like the real estate, the housing market moves, kind of trends develop very slowly. And then when they peak, then all of a sudden the activity becomes really fervent. It's like a Roman candle, and then it crashes. So, and that's at the point of where we are. A lot of markets are already starting to crash. I mean, I just read an article the other day. There's the largest commercial property firm in Denver is expecting a 20% vacancy rate as the energy fallout the full brunt of the energy fallout hits Denver. And that's going to affect a lot of markets.
Yeah, because Denver is an energy producing economy, right?
Well, Denver's got a lot of balls in the air. It's got technology. It's got big government installations, energy. The weed economy has really been a shot in the arm to the economy here. But that's going to lose traction also as the market gets saturated. So I guess the thing of it is we're not going to be able to map out how this thing's going to collapse because it won't necessarily collapse the way it collapsed in '08. I mean, really, everyone was looking at the mortgage bubble and the credit derivatives bubble and the housing bubble. Okay, that's what's going to undermine the market. And really, what it was the more I think back on it, it was really when AIG defaulted to Goldman Sachs on credit default swaps. That was really what really sent things south.
So it was the derivatives market.
It was the derivatives, yeah, but all of it contributed to that. But I guess my point is that the Fed can anticipate what it already knows has happened and what it already knows has developed. What it can't anticipate or what it can't try to fix is what it can't anticipate. And I don't know. No one knows. That would be your so-called black swan. I mean, the Fed knows how to prop the market up now. And their worst case is they just unplug it. I mean, we see these ECNs go down all the time when all of a sudden there's huge amounts of sell orders that flood the system. They never go down when the market's spiking higher. Amazing how that works, isn't it?
Yes.
So, and then we had that day, I don't know, maybe about 9 months ago. It might have even been last spring and I wrote about it on my blog, when the whole market was shut down temporarily. They basically unplugged the NYSE because there was so much selling coming in and they couldn't control it. So they know how to control that. They just unplug the market and they throw liquidity in there and they tell everyone to stop selling. They plug it back in and we go back up. But there's going to be something that hits that they're not going to be able to anticipate, and that's probably where the collapse starts.
Well, see, I believe we're already in. I believe the collapse is already happening. I think that the mirage is beginning to lose some of its luster, and that's what we're seeing in the housing market, like in Denver and in San Francisco. I just think that some of this so-called hot money is chasing cities like Nashville, Atlanta, and one or two others. But for the most part, it's done. It's over. Can they turn the printing press on the way that they have in QE1, 2, 3, Twist, and all the other nonsense that they've done? I don't think they can do that anymore. And if they do, the creditors are gonna run, with the exception of the Fed. And the Fed takes money out of their left pocket, puts it in their right pocket, and says, "See there, it's all good." But the people around the world are going to go, "It's not all good. We've got these other systems. We're not. You guys just became an island. We're not going to deal with you at all." Or am I just whistling Dixie over here?
Well, again, I think you're searching for answers that aren't answerable, to issues that aren't answerable. I mean, I've been straining my brain for a few years now, trying to figure out where the crack is in the Fed's ability to keep things propped up. And I do think, like you said, everything that's going on is a mirage. And I do think underneath there's cracks forming. The auto loan delinquencies, student loan delinquencies. We're going to start seeing people who took down mortgages that they can't afford. They're going to start defaulting on those. But I think they have ways of covering that up or deferring the collateral damage from that for as long as possible. There's going to be something that happens as a result of all of their intervention that they can't anticipate that's going to blow it all up, and I don't know what that is.
Okay.
I mean, in the meantime, though, it doesn't really matter. I mean, I refuse to jump into the stock market and go long, and it could melt up here. I don't know. But I will say that the precious metals are doing what they're doing because the precious metals sense something really bad is going on, and the only way the Fed can try and treat it is to do whatever they're going to do to flood the system with liquidity and keep it alive, and that's the perfect environment for precious metals to go a lot higher.
So gold and silver smell blood in the water.
Exactly.
And the miners as well. The miners are leading the charge, and that's really where all the smart money starts, right? I mean, they go into the miners, and then they start taking out the physical.
Well, I think it kind of just depends. I mean, the funds that are dependent on just showing performance, they just chase the miners. But the people, the institutions, and the smart, wealthy money that's interested in preserving their wealth, they're going right for the physical. And that's why we saw, I guess it was the first quarter, Gold Eagle sales from the Mint hit an all-time high.
Yep. And I think they're going to do it again this month.
I have no doubt about it.
And I think that if they weren't rationing the sales of Silver Eagles, they would be completely out of control. It would be beyond anything that has been ever seen before.
Yes, I agree. And they tried to hammer gold last night, and they weren't able to do it. And gold's bounced right back, and it's flat on the day right now. But silver's still up 16 cents, so almost 1%.
Yeah, and it actually was a little bit higher than it is now. Earlier today, and gold was actually running green for a number of hours. Well, Dave, it's always good. Get caught up on the markets, and we'll do it again in a couple of weeks and see where we stand.
That sounds good to me, Rory. We'll speak to you soon.
All right, dude.